This class is financial management. My name is Kirby Arcundiff. I have a Ph.D. from the University of Illinois at Urbana-Champaign. I'm a chartered financial analyst and a certified financial planner. I currently work as a chief economist and adjunct professor of accounting and financial management. In today's lecture, we will cover the second half of the chapter on time value of money in the excellent text by Brigham. There are many different types of interest rates. The nominal rate is the rate stated in contracts and quoted by banks and brokers. We will not use it in calculations or show it on timelines because periods per year must be given, and those will be used to calculate the rate that will be used on the timelines. Examples of nominal rate quotes would be 8% compounded quarterly or 8% compounded daily, 365 days a year. The periodic rate is what we will use on timelines, and it is the nominal rate divided by M, where M is the number of compounding periods per year, for example, 4 for quarterly, 12 for monthly, and 360 or 365 for daily compounding. We can also have continuous compounding. So an example would be 8% quarterly, that's 4 periods, that's 2% per quarter, or 8% daily using a 365-day year would be 0.021918% per day. What is the impact of compounding? Will the future value of a lump sum be larger or smaller if we compound more often, while holding the stated I% constant? Well, the answer is it will be larger because if compounding is more frequent, then you earn interest on the interest more often. So continuous compounding will give you the highest rate of return, followed by daily compounding, semi-annual compounding, quarterly compounding, and yearly. Here is the future value formula for different compounding periods. If we take this to the limit of m going to infinity, it will give us the exponential continuous compounding equation. So we have future value is present value times I plus I nominal over m to the nth power, where m is the compounding period, and then to the nth power, where n is the number of years. As an example, how about $100 at a 12% nominal rate with semi-annual compounding for 5 years? So our rate is 12 divided by 2, or 6 per semi-annual time period, and then we take it to 2 times 5, or 10 semi-annual time periods, 2 per year for 5 years, and in this case, the future value of $100 is $179.08. If we look at the example of 12% nominal rate for 5 years with different compounding periods, starting for annually, then we had for annually 176, for semi-annual 179, for quarterly, or 4 times a year, 180, and for 12 times a year, monthly, we get up to 181, and for daily, 365 times a year, 182. So what we show here is the more often compounding takes place, the more interest on interest you earn. In this case, a difference over the examined rates of around $6 on the $100 investment. Another type of interest rate is the effective annual rate, EAR, or EFF%, and it's the annual rate that causes present value to grow to the same future value as under multiple compounding periods. It is a convenient rate to use for comparison. If a bunch of different banks quote you different interest rates, this can tell you which one is the better deal for you. So in this example, invest $1 for 1 year at 12% semi-annual. Well, that'll give you $1.12 at the end of the year. Well, that means the 12% semi-annual rate is the same as 12.36% annual rate. To see how the formula for EAR is derived, we can look at the bottom equation here. Future value equals present value plus 1 plus equivalent annual rate to the n, where n is the number of years, has to equal present value times 1 plus I nominal over the number of compounding periods to the number of compounding periods to the number of years. We merely take off n on both sides, take off PV on both sides, and solve for the equivalent annual rate that gives you the same future value as a nominal rate with m compounding periods. And that gives us our top formula. EAR equals 1 plus I nominal over m to the m minus 1. In the example of 12% compounded semi-annually, we get 12.36%. We will go over calculator settings in a separate video. The effective annual rate for a nominal rate of 12% can be shown to be 12% as an annual rate for EAR, 12.55% if EAR is calculated from a 12% quarterly rate or compounded 4 times a year. 12% compounded monthly or 12 times a year is the equivalent to an EAR of 12.68, and 12% compounded 365 days a year is the equivalent of an EAR of 12.75%. Can the effective annual rate ever equal the nominal rate? Sure, if you have annual compounding, RM equals 1. If compounding is more than once a year, then EAR will always be higher than the nominal rate, the limit being continuous compounding. So when do we use each rate? Well, the nominal rate is written into contracts quoted by banks and brokers, but not used in calculations or on timelines, whereas the periodic rate is what we will use in calculations and on timelines. The effective annual rate can be used to compare returns on investments with different payments per year, and can also be used in more complicated calculations if and only if dealing with annuities where payments don't match interest rate compounding. Next, we will discuss amortization, as in amortizing home loans. Normally, if you buy a house with a 30-year fixed-rate home loan, you make a monthly payment, and part of that monthly payment goes to interest, part goes to principal. In general, most goes to interest, and you only reduce principal very, very slowly. As a simple example of that, we will construct an amortized schedule for a $1,000 10% annual rate loan with 3 equal payments. So if we look at borrowing $1,000, paying it off over 3 years with equal payments using the financial calculator, we would hit 3N. 10 is our interest rate I, minus 1,000, or plus 1,000 if we want the opposite sign of the payment. PV, 0 FV, since we're paying it off in 3 years in this example, or 30 years in a home loan. Hit compute payment, and we get 3 equal payments of 402.11. So we're paying off approximately $1,200 off a $1,000 loan, the extra $200 being interest. So interest goes down every year since we've paid off part of the principal. For the first year, we owe $1,000 at 10% interest, or $100, and therefore our repayment on the loan, if the total payment is $402.11, interest is $100. The repayment towards the loan is $302.11. And at the end of the year, we have paid down $302. We are left with a remaining principal of $697.89. So for the second year, we will only be paying interest on the $697.89, or roughly $70 in interest the second year. So if we repeat this for all 3 years, we show the beginning balance at the beginning of each year is $1,698,366. The payments are the same at $402, but the interest goes gradually down from 100 to 70 to 37. So the principal being paid goes up from 302 to 332 to 366. And at the end of the life of the loan in 3 years, the ending balance is 0. It is paid off. Total interest paid, $206.34 of the payment here of $1,206.34, the remaining being the paying off of the principal. We can graph this out nicely here, showing as the life of the loan increases, the amount of money going towards paying off the principal increases and paying off interest decreases. So this is the way home loans and car loans are handled. Unlike bonds, in the case of a bond, you end up with a big face value paid off at the end, and you only pay interest each year. So amortization tables like this are widely used for home mortgages, auto loans, business loans, retirement plans, and more. They are very important. Most commonly, you will use an Excel spreadsheet to calculate these, but the financial calculators are also useful for them. And of course, if you take the CFA exam, you can only use certain financial calculators, the HP discussed here and the BAII 2+ on the exam. Next, we will discuss more complicated calculations where EAR can be helpful, involving fractional time periods. So let's say on January 1, you deposit $100 in an account that pays a nominal interest rate of 11.33463% with daily compounding, and ask how much will you have on October 1st or after 9 months or 273 days. Well, here is our daily compounding period, and we want to know the future value. So again, we can use this with a financial calculator. We can calculate this R by hand. If we do it by hand, we invest $100. We have 1 plus this daily interest rate taken to the number of days, 273, and we get a future value of $108.85. If we do it on the financial calculator, well, we have our periodic interest rate here, again, of 0.031054 per day. We have our number of days here, so we hit 273 in 0.031054I minus 100 PV, 0 payment, hit compute future value, and we get 108.85. So some of the more complicated problems that we will deal with, again, where EAR is useful, would include non-matching rates and periods. For example, what's the value at the end of year 3 of the following cash flow stream if the quoted interest rate is 10% compounded semi-annually? So we get $100 every year, but that's every other semi-annual period. So we get 5% here, 5% here, a payment of 100, then there's a 5% right here, 5% right here, payment of 100, 5% right, 5% here, payment of 100. So to do this, you have to calculate the EAR per year to figure out either the present value or the future value of this cash flow payment, since interest is paid on a 6-month basis, but the payments are actually made on an annual basis. So payments occur annually, but compounding occurs each 6 months, so we can't use normal annuity valuation techniques. Instead, what we will do is a calculation like this. So the last $100, if we want a future value, we just receive without any interest. The $100 a year before that pays interest twice. So the $100 a year before that, we'll get 100 times 1.05 For the first time period, the second time period, you will have $105 during interest, and you will take that times 1.5 again, so you get 1.05 squared. This 100 here gets interest for 1, 2, 3, 4 semi-annual time periods, so you take 100 times 1.05 to the fourth, you sum all these up, and you get $331.80 is the future value. We could also calculate the EAR and treat as an annuity using the financial calculator. The EAR is going to be 1 plus 10 divided by 2 squared minus 1, or 10.25%. So for an annuity now, our interest rate is 10.25%. We have 3 time periods, 3 payments of 100, initially future value. We go 3N, 10.25I, 0 PV, minus 100 payment, compute FV, and we get 331.8. What about the present value of a cash flow stream where interest is compounding at 5% twice a year, but payments only occur once a year of $100? Well, the first payment of $100 would be discounted by 1.05 squared, which gives us 90.7. The second would be discounted $100 divided by 1.05 to the 1, 2, 3, 4, right here, which gives us 82.27. And the final payment of $100 would be discounted by 1.05 to the 1, 2, 3, 4, 5, 6, which gives us $74.62. The present value is the sum of all 3 of those, are $247.59. In our next example, we will look at comparing different investments. Say you are offered a note that pays $1,000 in 15 months, or 456 days, for $850. You currently have the $850 in a bank that pays a 6.76649% nominal rate with 365 daily compounding, which is a daily rate of 0.018538%, which can be calculated using the previous methods as an effective annual rate of 7%. You plan to leave the money in the bank if you don't buy the note. The note is riskless. The bank is also FDIC guaranteed. Should you buy the note, i.e., which one will give you the better rate of return? Our calculation for this situation looks like this. We have a daily periodic rate of 0.018538%. We have currently $850 in the bank, and we have the option of exchanging that for a note that gives us $1,000 in 456 days. We will now use various techniques to compare these 2 different investments. So there are 3 different solution methods. We can look at the greatest future value of wealth, the greatest wealth today, or the highest effective annual rate, our rate of return. So first, the greatest future wealth, we will find the future value of $850 left in the bank for 15 months and compare that with the $1,000 we would get from the note. So the future value in the bank, we have $850 as the present value. We have 1 plus this as our daily interest rate for 456 days, gives us $924.97 in 456 days if we leave it in the bank. But if we were to buy the note in that same 456 days, we would have $1,000. So the note looks like a better deal, and we should withdraw our money from the bank and buy the notes. The calculator solution for this would be hit 456 in, hit 0.018538I for our daily interest rate, hit minus 850 PV since our negative is deposited in the bank, 0 payment, and we end up with a future value when we hit compute future value of 924.97. The next possible calculation would be the greatest present wealth. So we now find the present value of the note at the quoted interest rate and compare it with its $8.50 cost. So our interest rate is still the same of 0.018538. So we take 1,000 divided by 1 plus that interest rate to the 456 days, and we get the present value is $918.95 for the note, compared for the present value of the money in the bank of $850. So again, we are better off buying the note. This same calculation can be done with the financial calculator, in which again we have daily interest rate of 0.0185358 and 456 days, so we had 456 in, 0.018538I, zero payment 1000 FV, hit compute PV, and we get minus 918.95, which is the present value again of the note, which is still greater than the $850 cost, so you buy the note. The final calculation would be to calculate the rate of return of each financial product. We would find the EAR on the note and compare it with the 7% EAR which the bank pays, and that is your opportunity cost of capital. So we look at the equation future value equals present value 1 plus I to the n. Future value is 1,000. Present value is $850. We solve for I. We can use this general formula here. So I equals FV over PV to the 1 over n minus 1, or 1,000 over 850 to the 1 over 456 days minus 1, which gives us 0.000356546 for the daily rate. We can also do that on the financial calculator by hitting 456 in minus 850 PV, zero payment, 1,000 future value, compute I, and we can get our daily rate for purchasing the note of 0.035646. If we convert that to an effective annual rate, then we take 1 plus that interest rate to the 365 compounding period minus 1, and we get a rate of return of 13.89% for the note, which is greater than the 7% on the bank account. So once again, the note gives a higher rate of return at close to 14% than the 7% on the bank account. So for all three of our calculations consistently, we choose to buy the note. It gives us the better rate of return, and we are told that both investments are risk-free. I thank you for watching this video.